Three quality stocks to buy near their 52-week low. This is a video I do every Saturday where I discuss some amazing companies trading near their 52-week low. The first one is Nike. Nike is down 57% over the last 5 years, and I've been, bearish on Nike since 2023 pretty much. Nike has committed the mistake of the century, I would call it, whenever they believed that the demand that came from the stimulus check was permanent, but it was not permanent. It was temporary due to the stimulus checks. Then the stimulus check money ran out and inventories have skyrocketed to the stratosphere as the company again ramped up production. So they had to fire a lot of employees and reduce costs, and they had to sell them at a massive discount for them to reduce the inventories. And the company is still declining in revenues till today. And this is really, really bad for Nike. Now, the last report was not too bad. They put up 53 cents versus 38 cents expected, and they pretty much met revenues expectations. The company has grown 9% in North America, which is a massive improvement under Elliott Hill, but they did decline in China about 17%. Now, while Nike has declined 17% in China, Adidas has reported 10% growth in China. This is very, very interesting. So maybe not all of it has to do with the Chinese market being weak, but it's also due to the consumer's preference, which is something that's extremely hard to predict. They like Nike today, they might like Puma the other day, or Hawk or whatever kind of shoes. So Nike does not have the moat and the pricing power that it once had, in my personal opinion. Now, they expect the third quarter revenue to fall by low single-digit percentage, unfortunately. And it also anticipates gross margins will drop by about 2%, mainly due to the tariffs, as they had a lot of China exposure, and I believe exposure in Vietnam, and the tariffs are hitting Nike, and it's going to hit them by about, I believe, 2.5% in total. Now, if we look at the valuation of Nike, it's still trading at 30 times earnings. I think 30 times earnings is ridiculous for a company that's still declining in revenues. Or if they grow revenues, maybe they grow 5%, 6%, 7%, or 3%. 30 times earnings is absolutely ridiculous. But it was trading at 50 times, and it trades at a high multiple because it's a quality company. And I'm not a big fan of that, to be honest. And I believe 30 times earnings is still a little bit expensive, but the company is expected to massively ramp up earnings per share growth to 50% next year due to the turnaround, and 23% the year after. So for my valuation model, I'm taking $3.07 for 2028, and I'm putting in another 2 years after that of 15% in earnings per share growth. I would get the 5-year earnings per share target of $4.06 in earnings per share. Nike right now is trading at 30 times earnings. So we're going to take $4.06 per share. We time it by 30 times earnings, which is our 2030 estimate. That would be $121 per share. The current share price is about $58. So we divide it by, $58. You get about 100% on the upside over the next 5 years with Nike. And you also get a good dividend, which is about 2.7%, and it's well covered. So it's really not bad over here. But for me personally, I would not be willing to bet on Nike trading at 30 times earnings 5 years from now. I think there is a lot of changes in the consumer preferences, and I would not be surprised to see Nike at 25 times earnings 5 years from now. Now, if Nike trades at 25 times earnings, and I take in the $4.06, I time it by 25 times earnings, I'm getting $101 on the upside. If I divide it by the current price of 58, that's only about 75% on the upside, excluding the dividend. So for me to get a double on this scenario, I would have to buy Nike at about $50 per share. So I believe Nike is fairly valued at best. It's really not a bargain at all. If it gets to $50 or below, it would be offering some margin of safety, but I still believe it has further room for a potential multiple contraction. And that's my review on Nike. The second one is Costco. Costco is an amazing company. It's down 13% over the last 6 months, and many investors are confused on why Costco is going down so much. But I personally been noticing a trend in the overall market, and this is that a lot of the compounders like Procter & Gamble and General Mills and many of those legacy compounders with very little revenue growth that were trading at sky-high multiples just because they were quality companies, they're breaking down in real time. And the compounders have stopped compounding. Even MSCI has pretty much been flat since 2021 because the stock was trading at 60 times earnings just because it's a quality company. So I believe we had a quality investing bubble in general where a lot of those stocks got bid up to the stratosphere and now they're coming back to reality. And I think Costco is having its moment as well. Now, Costco, despite the sell-off, is still trading at 41 times forward earnings. 41 times forward earnings is absolutely crazy for a company like Costco. On a trailing basis, it's trading at about 49 times trailing earnings. The stock was trading as high as 61 or 62 times earnings. It's twice as expensive as Google. It's more expensive than Microsoft. It's more expensive than Amazon. And I would buy those stocks before I would buy Costco any day. With the average for Costco was 38 times trading earnings. Now trading at 49 times, and it was trading at 38 back in 2023. So I'm not sure why Costco is much of a better company in those 2 years for it to warrant an expansion from 38p to 60p. I mean, the market got extremely irrational, and I think the stock is coming back to reality. The company is growing comparable sales about 7%, which is really healthy for a retailer in general. 7% is really, really good, and not a lot of retailers can put up 5 and 6 and 7%, especially from the maturities of Costco and its scale. For earnings per share, the company grows about 9%, 10%, 11% is expected. So I'm taking 11% as my base case for this valuation model, and I put in 11% earnings per share growth for the next 5 years. The current PE ratio is 49 times. I think this is ridiculous, but let's assume it trades at 49 times 5 years from now. Then my upside is 80%, or about a 12.7% annual return on Costco over the next 5 years. This is, to me, it's not enough, but it's really not bad at all for such a safe, good company in general. But for me personally, again, I can't sleep well at night paying 49 times earnings for Costco. If I want to make an assumption on Costco, I would bet on a reversion back to the average of about 38 to 39 times earnings at my base case scenario. So I put in 38 times for the next 5 years. I would get only 40% on the upside if I'm buying Costco today, or only a 7% annual return. And in this case, I would have to pay about $605 to get a double or a 15% annual return on Costco over the next 5 years. So this is my assumption. Based on 46 times, or this one actually should be 49 times, but based on 49 times for Costco, I would have to pay about $781. This is the best case ever for me to get it double over the next 5 years. As a base case scenario, I'm putting in 38 times forward earnings. I would have to pay $600, or it's negative 29% from the current price. So for me, I have a range on Costco between 780 and 600. I think anywhere in this range will likely end up being a great time to be dollar cost averaging or starting a small position in Costco. I highly doubt Costco is going to $603, but I can see it potentially going to 780. And I think under 780 it will start to somewhat make sense, a little bit at least, but it would still not be a bargain. But this is my range for Costco. And by the way, I'm using Fiscal.AI to come up with all those charts. If you want to try them out, they give you 2 weeks of free access if you use my link in the description. The last one for today is Procter & Gamble, and this is a stock that I called a trap not long ago, and people got upset that I called it a trap, but this is really a trap, and I still believe Procter & Gamble is a trap. The company has some amazing brands like Crest and Tide and Dawn dish soap and Ariel and Always and Pantene and Pampers and Bounty, and they have so many brands, it's not even funny. They have pretty amazing brand, and Gillette and so many others, and those are recession proof. They're not going anywhere. You're gonna have to buy them, you're gonna have to use them. Now the only problem is over the last 15 to 20 years, especially over the last 5 to 10 years, Amazon, for example, has been coming up with their own in-house brands. So if people want to go buy something on Amazon, let's say it's Dawn dish soap, maybe Amazon has their own brand that will put it on the first page on the website, and then people will say, oh, this is $5 cheaper, let me try it. Maybe it was Always, maybe let me try the one that's $2 or $3 cheaper, or let me try the brand that some influencer on YouTube is using, which isn't Always, which isn't Oral-B, which isn't Gillette or Old Spice or these kind of companies. Like they have a company called Dollar Shave Club. For $8 they send you razors or whatever, and a lot of influencers use it on YouTube and people see them and then they want to use the same thing. So the brands, they don't command the pricing power that they used to, and you can clearly see it in the number. The company's volume growth organically is 0%, sales growth is 2%, mainly due to pricing, and total earnings per share growth is barely 3%. This is absolutely crazy. Now, what do you believe Procter & Gamble is trading at? It's still trading at 20 times earnings. It should trade at 26, 27 times earnings. That was absolutely ridiculous. Now it's trading at 20 times earnings, and I still don't believe Procter & Gamble is cheap or it's undervalued. The company is a dividend king, I believe they call it, or aristocrat, or whatever it is, but it pays about a 3% dividend, and it's well covered within a free cash flow yield of 4.6%. So if I want to estimate an annual return for something like Procter & Gamble, I would take in the free cash flow yield, which is 4.6%, and I would add it to the revenue growth, which is about 3% on average. So I would get maybe a 7 or 8% annual return. And I'm not seeing a multiple expansion from here because I don't see how the growth of Procter & Gamble is going to pick up from here over the next 1, 2, or 3, or 4, or even 5 years. I think this is a company that's getting disrupted in real time by a lot of younger companies, and a lot of younger people are open to trying new things instead of paying up for something like Pampers or whatever it is. So I see a 7, 8% annual return. I think it's overvalued. I think Costco is overvalued as well, and I think Nike is overvalued as well. But if I had to rank them, I would put Nike first, then Costco, and the last one would be Procter & Gamble. So that's my opinion on those 3 stocks for today. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.